We've just come off the worst week in the S&P in 2025 so far, with red right across the board, but we notice Nvidia just this week is down 10%, and when we look at year to date, we do see a lot of mixed results. Some companies down double digits, others performing good in the green, but we notice Nvidia down 16%, which is very large given how strong of a 2024 this company had. And whilst they are up around 22% over the last year, we can in fact see year to date this company is really struggling. So is this company now looking like the buy of the decade, trading in the mid to lower end of the 52-week range, with a strong buy rating from Wall Street as well as a buy from Seeking Alpha? And bear in mind, this company has massively outperformed the S&P over the last 10 years, up 19,758%. We also notice the forward P does sit at just above 25, which looks to be incredibly cheap in comparison to its historical averages, something that we will touch upon. But starting first with the institutions and what they're doing, 65% ownership, 68 billion worth of selling by the institutions over the last year, a lot more buying, 390 billion in fact, and over the most recent quarter, institutions bought nearly 3 times as much as they did sell, so clearly very obvious that institutions are bullish. Now, as we highlighted, the forward PE does sit around the 25 mark, and when we look at the 5-year average of 42.9, this is what we would consider a severe undervaluation signal and would only make us want to dive deeper into the company. And the other thing we like to look at is this valuation model, looking as far as the last 5 years in terms of the forward PE. The blue tunnel here does show us the expected fair price. Nice to see it is increasing over time, something you want to note with companies you're invested in. You want them to be worth more as time progresses, but what we're noticing is there's disparity, and it's getting even further as time goes on to where the company sits and even the lower end of the blue tunnel, again reconfirming what we just said minutes ago about a severe undervaluation signal. Now, if we were to compare this company against the sector of 22.6, this is effectively telling us you are paying an 11% premium, and for a company, as we will come to show you, looks very strong in relation to the sector, you could argue not only does it deserve a premium, but one that is much higher than 11%. And as we just highlighted, it does sit below their own 5-year average, right now in fact around 48% lower. If we look at the makeup of their revenue as well, especially over the last few years, the massive driver of their top line has come from data centers, which has only been increasing on a quarter by quarter basis. If you look at their most recent earnings, 36 billion, or just below in fact, came from that element. And if we look at the same quarter in FY24, we're talking nearly half as much. So just in 1 year, they've managed to increase their data center by nearly 100%. And as we do look at the other income streams, whilst they have been growing for the large part, the main key point of their growth story so far has been the increases in the data center element, which, as we can see from just their latest quarter, it is increasing at a double-digit rate, even from the previous quarter, up 16%. And we can see their total revenue up 12% on a quarter-by-quarter basis. And whilst we will cover the margins shortly against the sector and their own historical numbers, we just want to flag that their bottom line net income margin sits at around 56%, which is very impressive, one of the best we have come across on this channel. And whilst looking at their latest quarter earnings, they did come up on top. 39.33 billion was what they reported, 38.05 was what the market forecasted, very strong beat in fact, and the same to go for their earnings per share, 89 cents, market was expecting 84. On top of that, their profits were up around 80%. As we can see, the tech AI boom continues, with a lot of companies looking to increase in fact their spending on artificial intelligence, on their strategy for the longer term. And just by looking at Nvidia's metrics over the last few years, you can see how impressive they are. In fact, their revenue has more than doubled from the previous year. Their margins have gone from 41% in terms of the operating margin in 2021 to now sitting at 67%. So not only rapid growth to their revenue, we're seeing the same be applied to their margins. We love to note the efficiencies, and the exact same thing to be shown on the free cash flow, going up more than double from 27 billion in 2024 to now sitting at 61 billion. And we just highlighted data center being the main reason for the large increase. In fact, it's nearly tripled from the previous year, and if you go back as far as the last 5 years, they've grown their data center element 108% on a year-on-year basis. If we look at the next 4 quarters, they are expecting double-digit growth to the EPS for each one of them, and over the last 4 quarters, they have outperformed analyst targets, 100% track record. With their earnings per share of $4.50 for Jan 2026, the company now trades at a forward PE of 25.1. We also heard from many of the Mag 7 who were saying they're expecting to increase their spending on capital expenditures, which we do believe Nvidia will capture some of that. Meta in fact came out and said they're looking to spend $60 billion. That is the lowest out of all of them. We then heard from Alphabet, who are looking to invest around $75 billion. Microsoft continuing to reiterate their plan of $80 billion. And then we heard from Amazon with the largest amount at $100 billion. And they said this is a once-in-a-lifetime opportunity in AI, and they want to capture as much growth as they possibly can. And then when we take a look at the Metas, the Alphabets, Microsoft, and the Amazons, we can see their growth has only been increasing over the last few years, and we do expect this to continue, and Nvidia, in our opinion, will be one of those companies that will largely benefit. Now, one of the great things about this company is their return on invested capital. It is significantly high, not only above the 12% we would expect for the semiconductor space, but in FY24 it was 61%, in their most recent annual accounts sitting at 90%, and this is incredibly high, again one of the highest we have seen when analyzing companies, and if they can keep up this rate, it will only be to the benefit of the shareholder. In terms of revenue growth, will up triple digits over the last year, 114%. Over the next 12 months, anticipated 60, well above the sector at the mid-single digit, but also well above their own 5-year averages, and we can in fact see earnings per share, it is expected to grow at 35% when the sector in comparison sits at 15 below, and also their own 5-year sitting below at 27.6. Now, in terms of their revenue growth, just over the last 2 years, it has increased triple digit. As we saw, the next full year, they're expecting this around the 60% point. But even with large growth, there is still a lot of opportunity for this company to even increase their revenue further. Whilst we won't cover it in this episode, there is robotics, the automotive space as well, that will only help propel them even further. And another way they're improving the business is their profitability through their efficiencies. Gross margin 75%, well above the sector at 50%, above their 5-year at 65%. Bottom line, 56%, well above the sector at 4%, and well above their 5-year at 33%. So not only is the company growing their revenue at a much faster rate than the last 5 years, they're also improving their margins, both gross and net, whilst also being valued much lower than what they have historically, and their cash generated from operations, $65 billion over the last 12 months, significantly higher than the $15.5 billion from over the last 5 years on average, well above the sector at $107 million. We also notice their margins, as highlighted earlier, are only getting stronger, well above the minimum 16 for the semiconductor space, but going from 18 in 2016 to 62%, and this is a free cash flow machine, well above the 5% minimum on the margins, sitting at 47% in the most recent year. Net debt to EBITDA also looking absolutely fantastic. We want below 1.5 for semiconductors, and they have 0 right across the board and expected over the next 12 months, telling us it won't even take Nvidia 1 day to pay off all of their debt net of cash on hand, an incredibly strong balance sheet. Now, one thing we do need to consider is tariffs, and in fact, just at the beginning of last week, the shares were down 9%, similar to the majority of the market, but this company went down even further, and there is worry that this is going to impact Nvidia over the longer term, or in fact, at least while these tariffs are in place. Now, Forbes have come out and they are questioning whether or not the effect of tariffs are being overblown, and actually what we are seeing right now is great opportunity. When we take a look at what they say, effectively, we do not believe that the Trump administration's initial tariffs will have a material impact on Nvidia, as their chips are primarily manufactured by TSMC in Taiwan. However, they do say some of their systems and their computers utilizing these chips are produced in other regions, including Mexico, and therefore it is possible that some of these segments of the business may experience some impact. However, they believe the core of Nvidia's operations, the high margin GPU GPU division will remain mostly unaffected. We can also see that Nvidia generates around 47% of its sales from the US, and the impact on their margins is probably even less, and TSMC, one of their main contract manufacturers for GPUs, has announced plans to invest roughly $100 billion in new chip fabrication facilities in the US, which will help mitigate a lot of those tariff fears. We also had some news at the beginning of last week where Nvidia's unofficial exports to China faced scrutiny after they arrested some silicon smugglers in Singapore, who were ultimately charged on misrepresenting the final destination of the US manufactured servers. We can see that Singapore accounted for 18% of Nvidia's total revenue for the full year FY25. That is purely based on customer bidding location, but in fact less than 2% of their revenues in terms of the product shipped to country, and it doesn't at the moment seem to be a big deal. Now, with all of the issues that we have had over the last few weeks, we do in fact see only one analyst downgrade this company to a hold. They essentially saying there is less favorable risk to reward, and there are a lot of other better options in the market right now. But ultimately, investors are very worried about the shorter term. We can see that we are now sitting in extreme fear, and therefore right across the market, as we said, the worst week in the S&P, many companies are feeling a significant drop to their share price, and Nvidia is no different. And in fact, when we take a look at the S&P on a forward valuation, whilst we do get a lot of red across the board, as prices have started to come down, we are seeing more green, which is telling us the valuation is looking a lot more attractive. And based on these numbers, we can see in fact Nvidia sitting around a forward P of 20. The other model we used was sitting at 25, but the point goes is that Nvidia, as the price does come down, is only getting more and more attractive. Now, before we jump into the valuation, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning, so a new copy coming tomorrow directly to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below and you can sign up, read straight away, where you can also get access to severely undervalued stocks for the month of March, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then jump into our valuation, where our intrinsic price is $162, derived from the DCF model, where we have the free cash flow year on year updated for their full year of 2025. Over the last 5 years, it's grown at 153%, over the last 10 years at 104%, and moving forward, we have gone for an estimation of 20, but you can see here, low, medium, and high. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others. But based on 20% and the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and intrinsically 162 coming to 45% upside. Now, we will show you for full transparency at the 15% point, $115, 3% upside, and because that isn't far away from the current price, what this means, if you are adding this company around the 112, 115 mark, already baked into the numbers is a growth rate of 15% to the free cash flows over the longer term. Again, we'll show you for those that are a lot more optimistic at 25%, $227, indicating 103% upside. That is more than a double from the current value. Now, as always, we do like to take through the medium rate, so 20% today, and what in fact we can see is a margin of safety can be applied. Now remember, we use 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, a buy at $146, then we keep going till it's near the current trading price. And in essence, what we are trying to say in today's episode, you are getting a 30% MOS up to $114, and Wall Street themselves incredibly bullish with their strong buy signal. They see this at $177 over the next year, translating to 58% upside. But as always, let us know, 1, whether or not you believe the growth rate is appropriate, and 2, if 30% MOS is sufficient and you do agree with the upside. What we can also do is show you at the lower rate of 15%, even though it is trading around the current price, the margin of safety that you would get. So at a 10% margin of safety, it would be a buy at $104, at $15.98, and at 20% 92. But again, this will all depend on your growth rate expected over the longer term. And Wall Street's forecast remains unchanged, $177, 58% upside. Do give us your thoughts below. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have been buying given the volatility, and as always, have a great day. We'll see you all on the next one.